Many investors unknowingly limit their passive income by believing outdated myths about dividend-paying stocks. Today, we're going to clear up some of the most common misconceptions that could be hurting your returns. Before we dive in, remember, this is not financial advice. Always do your own research or speak with a licensed advisor before making investment decisions. So, why does this topic matter? Dividend investing is one of the most popular ways for everyday people to build wealth and generate passive income. But there's a lot of noise out there, half-truths, old advice, and myths that can steer you in the wrong direction. Believing these myths can mean missing out on better returns, taking on unnecessary risk, or simply failing to reach your goals. Let's cut through the confusion and talk about the 5 most common dividend investing myths, so you can invest smarter and grow your income with confidence. Let's start with the first myth. Myth number 1. The higher the dividend yield, the better. It's easy to see why many investors fall for this one. Dividend yield is simply the annual dividend payment divided by the stock price. For example, if a company pays $4 per share each year, and its share price is $100, the yield is 4%. So when you see a stock with an 8% or even 10% yield, it looks like a fantastic way to boost your income. But here's the catch. High yields can sometimes be a warning sign, not a bargain. A sky-high yield can mean the company's share price has dropped, often because of trouble in the business. Maybe their profits are falling. Maybe they're taking on too much debt. In some cases, the dividend might even be at risk of a cut. That's why it's important to look beyond the yield and ask, is this dividend sustainable? A more reliable approach is to look for companies with reasonable yields, say between 2% and 5%, and a strong history of maintaining or growing their payouts. Myth number 2. Dividend stocks are always safe. Dividend stocks, especially those from big established companies, are often seen as safe investments. While it's true that many blue-chip companies have paid dividends for decades, that doesn't mean they're risk-free. Companies can run into trouble, cut their dividends, or even stop paying them altogether. Industries can change, competition can increase, and financial mismanagement can take a toll. Take General Electric, for example. For years, it was seen as a dividend stalwart. But after a series of business challenges, GE slashed its dividend multiple times. Investors who relied solely on the company's past reputation were caught off guard. The lesson: even the most reliable dividend payers need to be monitored. Always review a company's financial health. Look at their payout ratio, which is the percentage of earnings paid out as dividends, and stay up to date with their business performance. Myth number 3. Dividend stocks don't grow. Some people believe that dividend-paying stocks are only for income, not growth. They think if you want your money to grow, you're better off with non-dividend-paying companies, like certain tech stocks. This isn't true. Many dividend stocks not only pay you cash, but also grow in value over time. In fact, companies that consistently raise their dividends, known as dividend growers, often have strong, stable businesses that perform well in the long run. Take a company like Johnson & Johnson. Not only has it paid dividends for decades, but it's also delivered solid growth in share price. Over time, reinvesting those dividends can make a big difference, thanks to compounding. Dividend stocks can offer the best of both worlds: steady income and long-term growth. Myth number 4. You only need a few good dividend stocks. Some investors believe they can pick a handful of high-quality dividend stocks and forget about the rest. While quality is important, relying on just a few companies can be risky. This is where diversification comes in. Diversification simply means spreading your investments across different companies, industries, and sometimes even countries. The goal is to reduce the impact if one company or sector runs into trouble. For example, if you only own 3 bank stocks and the banking industry hits a rough patch, your whole portfolio could suffer. But if you also own stocks in healthcare, consumer goods, utilities, and other sectors, your risk is lower. You don't need to own dozens of stocks, but aim for a mix across different industries to keep your income stream more stable. Myth number 5. Dividend investing is only for retirees. A lot of people think dividend investing is just for people who are retired or close to it. The truth is, dividend stocks can be a smart choice at almost any age. If you're younger, you can reinvest those dividends to buy more shares, helping your investment grow faster through compounding. Over time, this can make a huge difference to your total returns. And if you're retired or seeking income, dividends can provide regular cash flow to help cover your expenses. Dividend investing isn't just about collecting checks. It's a flexible strategy that can support different goals at different stages of life. Let's quickly review the key terms we talked about today. Dividend yield. This is the annual dividend payment divided by the stock price, shown as a percentage. It tells you how much income you'll get for each dollar invested. Payout ratio. This is the percentage of a company's earnings paid out as dividends. A lower payout ratio often means the dividend is more sustainable. Diversification. This means spreading your investments across different companies and sectors to reduce risk. So, to summarize, don't chase the highest yields, don't assume dividend stocks are always safe. Remember that dividend stocks can grow, diversify your holdings, and don't think dividend investing is just for retirees. When you understand these myths and avoid them, you're in a much better position to build a reliable, growing income from your investments. If you found this video helpful, please consider liking, subscribing, and sharing your thoughts in the comments. Let me know. What's one dividend investing myth you've heard, or a question you'd like answered in a future video? Thanks for watching, and I'll see you in the next one.